Hello, I'm Dr. Kavita Yadav, Assistant Professor in GFGC, Rajajinagar. Today's topic would be with regarding to derivatives. So let us know more about derivatives. Firstly, meaning of derivatives. See, derivatives are financial instruments used for trading in the market whose value is dependent upon one or more underlying assets. It is a security that derives its value from underlying assets such as stocks, currencies, commodities, precious metals, stock indices, etc. Derivatives represent a contract that is entered into by two or more parties, we tell. Okay, so what are derivatives means? They are nothing but financial instruments who derive its value from underlying assets. What are those underlying assets? They can be commodities, they can be stock, they can be currencies, they can be metals, etc. Okay, and derivatives represent a contract. Since derivatives are traded, if it has to be traded, there has to be two or more parties. Minimum two parties have to be, one a buyer, one a seller. So derivative represents a contract which is entered by two or more parties. Contract is with regarding to what, students? Contract is with regarding to trading of financial instrument called derivatives, which derives its value from an underlying asset. So derivatives are nothing but something which is derived, we tell. Okay, whose value is some derived from an underlying asset. If we have to give a simple life example, curd is derived from milk, isn't it? So what is the underlying asset here? Milk is the underlying asset. What is derived of milk? It is curd. Okay, so curd is derived from milk. Fine. Likewise, there will be underlying assets based on the value of which the financial instruments called derivatives are derived. Fine. So, this financial derivatives or a derivatives market, NSC, for your information, NSC is the largest derivative market. NSC is nothing but National Stock Exchange of India, and here Nifty 50 is the derivative, future derivatives, which is traded the most in the entire world. Okay. Firstly, derivatives started with commodities. Keeping commodities as underlying assets, derivatives started and in India, and after 1970 the derivatives entered into financial markets too. Okay. So NSC is highly renowned exchange which takes care of derivative transactions in India. See, these derivatives or these instruments are either traded over the counter or via an exchange. See, over the counter derivatives are one which is traded privately and without any intermediary, whereas exchange traded derivatives are traded via specialized exchanges such as Bombay Stock Exchange, we tell. See, since this is trade, it can be carried on in two methods. One is over the counter trade, we tell, that is over the counter derivatives or trade is where you don't have an intermediary, and between two parties without intermediary exchange of derivatives takes place, and it is non-standardized markets. In non-standardized markets, these over the counter derivatives are exchanged. Okay, the other one is through exchanges. Through exchanges, derivative trade takes place. Exchange becomes an intermediary. Here it is a standardized market where with a set of rules and regulations, the transactions takes place. So derivatives can be traded through over the counter or through specialized exchanges also who act as intermediaries. Okay, there are four types of derivative instruments. They are futures, forwards, options, and swaps. These are the four important derivative instruments. So now let us know about these derivatives. The first one is the futures. See, what are futures means? Futures are the standardized type of contracts entered into by two parties for buying and selling of underlying securities at an agreed rate price at some future date, we tell. Okay, see here there is a contract of exchange of derivatives, okay, at an agreed price at some future date. And we tell futures are standardized type of contracts, we tell. Okay, when we tell standardized type of contracts means it is done through exchanges. It is understood that it is done through exchanges. Buying and selling is done through exchanges. Okay, the rate of that, the price of that underlying asset is fixed at a future date and executed also at a future date. Such type of contracts are called as future contracts. If we have to have an example means, there are two parties, A and B. A is the farmer who wants to sell his mangoes grown in 10 acres of land, and B is a party who wants to buy mangoes to do his business. Okay, so what A does is he gets into a contract with B on 1st of Jan to to sell the mangoes on 30th of March. He is getting into contract on 1st of Jan, and he is telling the buyer that he will be selling the mangoes on 30th of March, a future date, which is 30th of March. So B is entering into contract with A to buy, entering into contract with A on Jan 1st, but agreeing to buy it on 30th of March, which is a future date. Okay, fine. So both of them have agreed. But at what price he sells and at what price he buys means the price will also be decided at a future date, they tell. The future date is the date on which it has to be executed. Which is the date of execution? It is 30th of March. So on 30th of March, what price prevails in the market? At that price, A will sell his mangoes to B. Okay, so such types of contracts are called as future contracts. So these are the traded over an exchange via intermediary and are completely regulated. Future contracts cannot be customized as per the party needs and carry lower counterparty risk. Okay, it has to be done in a standardized form by following all the rules and regulations laid by the exchanges, and therefore counterparty loss or risk will be less. Okay, counterparty loss or risk means one person loses at the gain of another person. So such risks will be less in future contracts because intermediary will be the stock exchange. Okay, and the value of these contracts is decided as per the market movement on a daily basis till the expiration date. So the prices will be fluctuating, and on the expiration date, whatever prices will prevail on that, at that price the contract will be executed. This is regarding futures. Next, it is the forwards. See, forwards are simply an agreement between two parties for buying or selling an underlying asset at a specified price at some future date. See, here also there are two parties who are doing buying and selling, and this contract also is a derivative contract based on some underlying asset. Okay, what is the difference between future and which will be executed on one future date only? So what is the difference between future and forward means? Here A is again agreeing to sell the mangoes to B on 1st of Jan, and they are getting into contract to execute it on a future day, which is 30th of March. Okay, A is also agreeing, B is also agreeing. But here the price difference comes. So I told at a specified price at some future date, this contract will be executed at a specified price. So what would be the price of the contract? Means it is the price that is there on 1st of Jan. That means they will decide the price on 1st of Jan itself when they get into the contract. So at that specified price, the mangoes has to be sold by A to B on 30th of March. Okay, so this type of contracts is called as forward contracts. So these are contracts which is done over the counter, and they can be customized, and there is no standardized mechanism to carry on these type of contracts. Okay, it is a non-standardized type of contract which is traded over the counter, and these contracts are flexible and can be customized according to the needs of the buyers and sellers. Okay, but there will be lot of counterparty risk. At one person's loss, another person may gain. All this will happen because there is no involvement of exchanges here to regulate the market. Okay, next you have got options. What are options? Means they are derivative contracts that provide the buyer a right but not an obligation to buy or sell an underlying asset. See, the buyer of an option contract pays a premium to the seller for buying such right, whereas the seller is under an obligation to discharge his duty in return for the premium he received. Okay, see here also there are two traders, two traders, one buyer and one seller. The buyer of the contract has to pay a premium to the seller, and once the premium is paid, the seller will come under the obligation of selling his goods to A, who has paid the premium. Okay, so on this terms, the options contract carries on. Options are of two types: call option and put option. See, when is call option carried on? Means call option is a derived contract between two parties. Whenever the market goes higher, call options are preferred, and whenever the market falls, put options are traded vital. Okay, whenever the value of the stock, whenever the value of the stock, if they predict, will fall. Okay, whenever they predict it may fall in future, they go for put options. Whenever they predict the underlying assets value may go higher, they will go for call options. Okay, so this way the options contract is carried on. Next you've got swaps. Swaps are the most complicated type of derivative contracts which are entered into for exchanging cash flows in future between two parties. Swapping means um, exchanging one item for another, or cancelling one item to another is called as swaps or swapping. So that concept is used even in derivative market to mitigate the risk of the parties. Okay, so these are the private agreements which are done over the counter. Interest, there are here also you've got two types of swaps: interest rate swaps and currency swaps are the two most common types of swap contracts. Regarding these concepts, we will be learning in our further classes or further slides. Okay, so these contracts carry a high amount of risk as the interest rate and currency rates are the underlying assets in these contracts, which are highly volatile vital. So what are the underlying assets in swap contracts? Means currencies and commodities. Okay, so both currencies and commodities are high, not commodities, interest rate and currencies, interest rates and currencies. Both interest rates and currency rates are highly volatile. Highly volatile means are highly changing in nature. So since these two are the underlying assets, swaps derivatives are highly complicated to handle. Okay, so these are the four types of derivatives that you can find in exchanges taking place. Next, you have got functions of derivatives. See, what are the various functions of derivatives? Means price discovery we tell. See, derivative contracts helps in determining the prices of the underlying assets. Okay, as I gave you examples of mangoes on in a futures contract on 30th of March, you could derive a price. On in forward contract on 1st of Jan itself, you could derive a price. So derivative contracts helps in determining the prices of the underlying assets. Future and forward contract prices are used in determining the future spot prices. So this way it is beneficial in discovering the prices we tell. Then you've got transfer of risk. See, derivatives are used for transferring the risk from one party to another, that is, buyer of a derivative product to the seller. It is an effective risk management tool that transfers the risk from those having a low risk appetite to those having a high risk appetite. Here in future and forward example, what I gave you, transaction between A and B, A is at a risk of not finding a right customer when his mangoes are ripe. So what he does is to mitigate that risk or to come out of that risk, on Jan 1st itself he is getting into a future contract with B. Okay, likewise B. So here buyer wants to set aside his risk. Okay, and he is entering into contract with B. So he is transferring his risk to B, and B wants to be uh, confident that he gets the mangoes at the right time to carry on his selling to the market, to carry on his trade in the market with regarding to mangoes. So he also wants to come out of his risk. So risk mitigation takes place when there is derivative contracts. Okay, transfer of risk. A is transferring his risk to B. That means what we can tell? A low risk appetite guy, it transfers his risk to high risk appetite guy. Then you have got hedging risk. Okay, here hedging means it is also an instrument which helps you to reduce or minimize the risk, or to cancel the risk, or to postpone the risk. So for such things we call it as hedging risk. So hedging risk means it helps in hedging risk against unfavorable price movements of an underlying asset. See, by entering into a forward contract, you can hedge your risk. See, for example, for forward contract, you are fixing the price on Jan 1st itself. But in future, the price of mangoes may fall. If the price of mangoes may fall too, the buyer B has to buy the mangoes at the specified price in the contract, which was the price of Jan 1st. So by doing this derivative contract, you are hedging your risk, you are transferring your risk, you are mitigating your risk. Okay, so hedging risk is hedging the risk, mitigating the risk is also one of the function of derivative. You can equip yourself against the risk, hedging against risk by hedging with regarding to when you get into derivative contract. Any unexpected hike or drop will influence the contract, and that can be mitigated when you are getting into derivative contracts. Then lower transaction cost. Lower transaction cost. The cost of trading in derivative instruments is quite low as compared to other segments in financial market. They act as risk management tool and thereby lower the transaction cost of the market. See, when we talk about transaction cost, you have got brokerage, you have got commission, you have got transportation cost, you have got physical delivery of cost. All this is reduced when there is derivative contracts taking place. So the transaction cost is quite less compared to other types of contract dealings. then provides access to unavailable assets and markets. Derivative enables business in reaching out to hard to trade assets and markets. So, hard to trade assets also can be brought into derivative markets and traded. Then, higher leverage. See, derivative instruments provide higher leverage than any other instrument available in the financial market. See, leverage means pushing up your profits, something which enhances is called as leveraging, isn't it? So in derivatives, your investments is less, but your returns is maximum. Okay, so leverage, you can increase your profitability by getting into derivative exchanges. So higher leverage is there. Higher leverage is also one of the functions of derivatives. Next we'll discuss about the advantages. So advantages, now only we discuss advantages are some of the points of functions only you can write as advantages. See, hedging risk, you can mitigate the risk transfer, you can transfer the risk by getting into derivative contracts. Then determining underlying asset price can be determined. Then provide access to unavailable market. Then enhance market efficiency. The market efficiency with regarding to trading can be enhanced in through derivative markets, and low transaction cost is also one of the advantage. What is the disadvantages of derivatives? Means high risk. See, derivative contracts are exposed to high degree of risk due to high volatile prices of underlying securities. The price future is unpredictable, and how much ever you are prepared for, there is lot of volatile changes that happens in derivative products with regarding to commodities. So fully you cannot mitigate risk, or fully you cannot be risk proof by getting into this one derivative markets. You expect something, but something else can also happen, and therefore high risk is there in derivative markets. Then counterparty risk, there is a possibility of default on the party of on the part of on the part of the parties, and counterparty in case of derivative traded over the counter lack due to lack of due diligence process. See, especially with regarding to OTC contracts, over the counter contracts, as I told you, their defaults usually happen, and when default happens, one party gains profits, another party has to face losses. So there is counterparty risk in derivative markets, especially in OTC trading. Speculative features. See, derivatives are instruments which are used for speculation purpose for earning profits. Okay, sometimes huge losses may occur due to unreasonable speculation, and sometimes high profits are also there. But speculation means what? You predict what may be the future. Sometimes you may predict there will be increase in the prices of the underlying assets, but it may not happen. And because of that prediction, you must have done investments, and since if it does not increase, then you have to face losses. So speculative feature is there in derivative markets, and therefore it is a disadvantage. Then requires expertise. See, this is one of the major drawbacks in trading of derivative instruments. Investors require high knowledge and expertise for trading in these instruments as compared to other securities like stocks and metals. So, if you have to trade in the derivative markets, you have to have thorough knowledge about the market. You have to be good in your predictions. You have to foresee what may happen. You have to have that expertise. Only then you can do good business in derivative markets. Okay, and this is not always possible by everyone in the market, and that's why this also is one of the disadvantages of derivatives. So today in this session we have learnt about what are derivatives, what are the types of derivatives, the functions of derivatives, advantages and disadvantages. Thank you.